I'm going to do a brief quarterly market report for 2026. I guess three key numbers are that the S&P 500, although it's had a lot of volatility and there has been certain sectors doing well, like energy, and certain sectors not doing as well, like tech this quarter, overall, it's been pretty flat. Interest rates, or the Fed rate, is around 3.5%, and oil is over, well, it's been bouncing around, but recently it's been over $100 a barrel, which you'll see reflected in gas prices. Another just snapshot, S&P 500's been pretty flat, although there's been a lot of up and down. An optimistic note, earnings per share, so companies' earnings per share are up significantly, and this is the fifth straight double-digit quarter. Oil, because of the Iran conflict and the blockage of the Strait of Hormuz, has affected oil prices, which is impacting other areas. And inflation is stubbornly above the Fed's target. You can see sectors that have done well: energy and utilities and healthcare. Tech has been not quite as good. Um, I guess value companies, that would be your energy companies, have outperformed growth, which would be your tech. And we are seeing more volatility than usual. This is above average volatility. The Iran conflict is shooting oil prices up. That Strait of Hormuz has about 20% of global oil supply going through it. And so that blockage is impacting oil costs. The International Energy Agency, they're going to strategically release a lot of oil, which may give some short-term relief to energy prices. But the energy sector has done well this quarter, that is pulling up the markets, or keeping it at zero at least. Why is higher oil important? Well, one, it can affect inflation. It can also decrease consumer spending because they're spending more money on gas and energy in general. Supply chains, their costs are up for freight, for transportation, and markets will see more volatility, just ups and downs. Inflation, here's a look at that. We are above the 2% target rate. It's been just hanging out there real close to 3% for quite a while. The global growth, US has done well compared to other countries, but it's low growth rates. The Fed's fund rate we already talked about, and the consumer price index is up about 2.6%. There are expected to be cuts this year, 1 to 2 times, maybe later in the year. The US dollar has seen some volatility as well this quarter. We've seen it go up in value versus other countries, lose value, and then recover a bit in March. Yeah, why this matters. A weaker dollar does boost your international stocks. They'll see better returns. But the US is a safe haven, especially in these volatile times. Fed's rate, we talked about this, a little bit above 3.5%. Yeah, the Powell's term ends in May. Kevin Warsh is going to be or expected to be the successor. We'll watch. He seems reasonable. It seems like there will be a separation from the Fed and the executive branch. We'll see. We'll see how that works out. But he does seem like he has history, and hopefully he stays independent of the short-term demands of the administration. Corporate earnings have done well, expected to continue to do well. This first quarter, we're still, reasonable returns so far. Of the companies that have returned earnings per share, we've seen more positive returns or reports than negative. And a majority of companies are exceeding their estimates. So companies are still doing well. So the big risks, Iran, what that conflict, how long it'll last, how involved that'll be, inflation stubbornly staying up, leadership change will be a bit of an unknown, and valuations are historically a little bit high on companies. Some of that's due to AI, just expected returns that we'll see if they materialize. Opportunities, markets doing well, value and dividend stocks are doing well, bonds and AI infrastructure. I mean, those are opportunities. Labor market. Well, AI in the labor market. Unemployment is up from 4.1 to 4.4 right now. Is AI a bubble? I mean, there's talk about there could be a dip. There's just so much invested. The valuations of these AI companies are really high. They may materialize and they may prove to be very profitable and deserve the prices they have. We'll see. There is some risk in the job market uh, because of AI displacement. Entry level white collar roles are seeing a big disruption. This also can be a productivity gain potential. So those that embrace AI and can leverage it and produce more gains at the expense probably of some people losing jobs, it could be more productive, more profitable. So more unemployment, although that's a bad thing, it may not be horrible for profits, for company profits, for the stock market. So if we're just talking about the stock market, it may not be a huge risk. Although if you have high unemployment, well, if you have high unemployment, then the Fed should be lowering interest rates to combat that. Healthcare has been the number one job creator. These AI resistant roles are doing well. So, just some thoughts about strategy, rebalance for sure. Just don't get over concentrated. Some sectors have gone up, some sectors have gone down, and you just want to stay balanced. Cash is probably not the best place to hold a lot of money right now. Just stay invested, think of the long term, and just stay rebalanced. AI grew a lot last year. It's nice to rebalance and not be overexposed there because of that growth. Things to watch, what the Fed does if they do drop rates one or two times this year, and it may be later in the year, maybe we'll see where that is. The Iran conflict and oil prices, that is something to keep an eye on. The earnings season, we're seeing reports. It'll be good just to see where companies are as the reports keep coming out. Fiscal policy and debt, international growth and inflation. These are all areas that'll impact the markets. Looking ahead, so second quarter and beyond, again, stay diversified. There's good expectations of reasonable returns or earnings per share, good earnings and growth this year. Earnings growth are expected to do well this year. And just think about the long term. I know it's a volatile time. We'll probably see a lot of dips. We'll see some recoveries, and just focus on the stock portion of your portfolio is for the long term. You can weather some ups and downs for that portion in the market, and don't get overly concerned with short-term market movements. All right, that's all I have. Let me know if you have any questions. Let me know if you have any concerns, questions. Again, stay diversified and focus on stick to your plan. Focus on the long term. All right, take care. Thank you. Bye.